Hey everyone, welcome back to Corporate Decoder. Today we are going to look into a report from First Trust Mortgage Income Fund, which sounds incredibly boring, but trust me, there's some unexpected twists in what looks like smooth sailing. This semi-annual report might seem like just another stack of numbers, but actually gives a lot of insights into the tricky world of mortgage investments. And if you're planning on investing in anything with a mortgage, you want to pay attention to this report. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more in-depth discussions. This is the First Trust Mortgage Income Fund's semi-annual report covering the 6 months ending in April 2025. It gives a snapshot of how the fund is performing, what assets it holds, and the risks it faces. Think of it like a health checkup for your investment, telling you if it's thriving or just surviving. First, we can see that the fund's share price is $12.09 and $0.09, which is the actual worth, is $12.75. This means the fund is trading at a discount of about 5%. Essentially, you're buying something for less than it's truly worth, but why is it happening? Looking at performance, the fund's average return for the 6 months is 4.46%. Now, when we stretch the horizon over the past 5 years, the fund has earned 3.64% annually. These numbers are important as they show you the money that you can expect to earn and how fast. Compared to its benchmark, the Bloomberg US Mortgage-Backed Securities Index, the fund is doing well in the short term, but it looks like after 5 years, the funds have underperformed the index. In simple words, some people who have selected the index have made more money. Here's how the fund's money is spread out. Leading the way are mortgage-backed securities at 56.1%, followed by US government agency mortgage-backed securities at 38. Asset-backed securities, money market funds, and some short positions. Now let's check the credit quality, and this shows how reliable the fund investments are. A big chunk is in AAA rated securities, while some is unrated. It looks like agency securities that are issued or in some way guaranteed by US government agencies make up 34% of the investments. Okay, now let's peek into the specific investments the fund holds. This is where things get interesting because you can see the companies themselves. For example, they got stakes in Citigroup Mortgage Loan Trust and Countrywide Home Loan Mortgage. Now, these are mortgage-backed securities, so their value is tied to the performance of a pool of mortgages. If a lot of people default on their mortgages in that pool, well, the value of the security could drop. They also have a stake in El Home Mortgage Trust, which includes securities that take a big step up in coupon rate starting in 2026. It is offering more interest, which is great, but might carry more risk. And the last example that can be mentioned is Washington Mutual, which is paying 12.83% in yield, but is tied into many things. I'm definitely interested in seeing what other crazy thing is here. Alright, enough examples, let's see how the market works. Some of the fund's income comes from floating rate securities where the interest rate changes with the market. One of them is pegged to SOFR, which is a benchmark interest rate. But because the prices are changing all the time, you never know how much money you can make. Here is how about they spread in CMBS's commercial mortgage-backed securities. The fund owns chunks of different series, which are basically bonds backed by commercial mortgages. Also, to reduce risk, they play around with other mortgage-backed security funds, such as Federal Home Loan Mortgage. Okay, not all their money is based on houses as it appears. They also invested in advertising companies. They got $1 million parked in Adams Outdoor Advertising. A big part of where they make their money appears to be from money market funds. Morgan Stanley happens to be managing it for them. Here's where things get a little more complex. The fund uses options, which are betting contracts to manage risk. They write call options, which could limit gains if the market zooms up, but also provide a hedge if things go south. This is basically a trade of one opportunity versus being safer. The fund also dives into futures contracts on US Treasury notes. These contracts let them bet on the future direction of interest rates to protect their investments. Now let's talk about how the fund values its investments. They use something called a fair value hierarchy, which has 3 levels. Level 1 is easiest because they just use prices from active markets. Level 2 involves observable data but not direct prices. Level 3, that is the trickiest, involves their own assumptions, which can be a bit subjective, but they don't have much tied to it. Here's where we see the big picture. The fund's total assets are about $60.8 million, but it also has liabilities like short sales and options contracts, which bring the net assets down to $53.7 million. Diving deeper, the total investment income is 1.4 million or so. But after all the costs like advisory fees, that profit decreases to around $1 million. They also took some losses from their trading activities, around $500,000. But luckily they have a net unrealized gain of more than $1 million, meaning that the people thought they would make less money actually made a lot of money. So after all the trading, they have net gain of 22 million, which is very good. The net assets went up, but after subtracting payouts to shareholders, we arrive at about $360,000 increase. The fund's net asset value per share increased a little bit from 12.67 cents to 12.75, so a small but still good increase. If you participate in the dividend reinvestment plan, any dividends or distributions will be automatically reinvested into additional shares. If you don't use plan, shares will be paid in case. Now to the elephant in the room, risks. There are many risks associated from investmenting, ranging from collateralized mortgage and non-agency securities that could seriously make you lose your money. All those risks have to be considered depending on your personal preferences. Now, looking at these results more broadly, First Trust Mortgage Income Fund is a mix of strategic plays and inherent market risks. With their focus on mortgage-backed securities, they're navigating a sector that's both essential and sensitive. While their performance metrics show both successes and areas for improvement, particularly in matching and exceeding benchmark indices over longer periods, the fund is trying to get money with high yield, which means higher risk. Alright, that's our breakdown of First Trust Mortgage Income Fund's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Also, don't forget to check out the Discord in the description. Thanks for watching. See you next time.